Good morning and welcome back to the Opportunistic Trader for Wednesday, 1:30, day before month end on a very good month for the U.S. stock market as well as global markets across the globe are all up about the same, which is unique to the last 3 years because most markets diverged over the last two, but this year pretty much everything is in line. S&P is up almost 6% for the month. The best start basically since 1987, a year that I remember well. Kind of started out the same way in 1987 with the markets going significantly higher for pretty much the first half of the year, and then we had the crash of 87. Started in August and crashed in October. Last night, Apple's earnings were out. The stock is up. It was down 2 yesterday. It's up 6.60 today. Interesting. I was actually talking with CNBC yesterday, which we were published, and they were asking me about Apple's earnings and what I expected. And basically, the options were square on right, predicting about a 4 to 4.5% move, and it's up. It was up higher, about 5.3%. Now it's up 4.2%. I think Apple is a short here. I think the number.
Larry, pardon me. I don't have the on what I'm looking at now. I don't. Where do you show it trading right now?
It's trading up $6.47 at 161.13.
Thank you.
Up 4%. So it's right in line with the options. Actually, the options are all going to pretty much be down today because they had this pretty much priced in. So we had those earnings along with a couple of others. Boeing's earnings were good. I'll look at the stock, see where that is trading. Boeing is, let's see. Boeing is up $20 pre-market or 6%. So their numbers were good. eBay down a little bit, but it's had a big run. Overall, I think Facebook is tonight. That should be a miss. I know everyone thinks they're going to beat, but I would think it's going to be a miss. Overall, technology, yesterday's trade was very interesting. It was a weird one. Technology underperformed the market big time. The Dow was basically up with the NASDAQ down at 1.90 points. So it was one of those days where they were buying those stocks. But overall, yesterday was quiet. China's holding up pretty well. Pricing in up about 1% tonight, so they should finish the month positive about 6 or 7%, which is a good start there. Bond market is mixed, obviously up on the year, and yields have contracted. I think the 10-year is at 275 and probably 272. That's pretty much where it's been. The market in S&P, it sort of had its move a week and a half ago, and we've been going plus or minus a little bit in here, and we're at the top, near the top end of the range, which was 2680. We're about 1% away from the top end of the range, and obviously 6% or 7% from the lows of the month. So the markets had a good month overall. Stocks in general, marijuana stocks did unbelievable this month. Bank stocks performed extremely well. Technology was a mixed picture, although NASDAQ in general was up as well. Some techs were down, some techs were up. But overall, stuff seems to be in the same spot that it really was a couple of months ago. You got Apple at 160, it made a low 141. You got Facebook at 145, made a low 125. You have Netflix at 332, made a low on that move down at like 250. Same thing in Amazon, 12 or 1300. So these stocks are significantly off the lows, but it doesn't feel like an impetus to rally hard here. Joined by Vince and Mike. Vince, if you want to sort of give your global macro view or thoughts, I would appreciate that.
Yeah, sure. I mean, anything said today has been said the last couple of days. You know, you have the FOMC coming up. Your comment about China, I think, is very relevant. China has, although they won't call it that, at least they haven't called it that yet. They've basically been doing a QE. If you're looking at international versus domestic equities, you're seeing some correction of the East versus the West. Uh, there are political reasons, but let's factor the politics out of it with the trade wars. The Chinese economy is slow and slowing and getting slower. And QE, for those of you unfamiliar with the guts of it, is actually pretty simple. On the monetary side, you print money. And on the fiscal side, you buy bonds. And what you're doing there is you're increasing liquidity to put money in stocks, right? Because the bonds are going up and the yields are down. And at the same time, you're increasing lending capability. And so that props up stocks and hopefully it drags the economy with it. What China is also doing that the US has done, but not so heavy handedly, is China is very aggressive when they do things. You'll hear the phrase capital constraints. They will just overnight lower what a bank has to have on hand. They'll just say, oh, well, you used to have 20% in your account to lend out $1 million. Well, now you only have to have 5%. They ease and tighten capital constraints, and they use that to titrate their QE. But they are definitely in what can be seen as a QE situation. And pivoting back to the trade thing, it on the surface that makes them look weak, but I'm not so sure about that. But staying with the macro and how it comes home, and I'm going to talk about very briefly Apple. I've talked about it several times in the past, and this is something that anyone can see, and it's not an active traders thing. Active trader wise, Apple's probably short today. But think back over the last several months. Apple has a history of managing earnings expectations very well. In the last two times before this one, they managed them poorly. Not only that, we were joking about the fact that they're being less transparent with analysts, not giving out the numbers on iPhones so readily, basically backing off from transparency simultaneously. And what was for most people unrelated, but not for me in my paranoid mind, I remember saying several times that I couldn't buy a cable anymore that wasn't $13 or more for charging my phone. And I did a little research, and they're tightening their licensing fees. Fast forward to today, they again managed expectations on earnings well again. They've been buying stock on the way down, and this is important if you understand business models for the long term, not for active trading. But Apple is a macro company, and what I'm getting at here is Apple's iPhone sales were down 15% last quarter, but everything else was up 19%. What is everything else? Revenues from license fees, the streaming music service. Apple is changing into an ecosystem model that is more like Amazon, meaning if you're already in their store and you're already buying music, why not stream it? And this is incredibly important, especially for traders that understand how we went from a floor to an electronic system. They're creating a product that competes with their existing product. I haven't bought anything on iTunes in 2 years. iTunes, I guess that's actually kind of funny. I haven't bought music or videos. And what they're doing is now they're buying video game companies like Minecraft. Don't be surprised if they don't buy Supercell, which has some great games. They're moving away from what's called the walled garden business model. Now, this is macro stuff, even though I'm talking about it in a stock. The walled garden says you must use an app, it must be on our device, and it must be here. The walled garden is what's called a closed ecosystem, and it always fails. But Apple really, really did a great job of running it for the last 10 years because they had the iPhone, the greatest innovation in years. But now the hardware doesn't matter as much anymore, and they're pretty smart. And I'm saying that Apple's going to reinvent itself in a more macro way as a company like Google with a better brand that's going to be selling you streaming music. That's going to be renting. Remember how when you go on Netflix, Mike, Larry, you go on Netflix, you can hit click and you can watch the whole season. Can't do that on iTunes. It's kind of annoying. But I have a feeling if you buy a whole season of Criminal Intent, you're going to be able to do that soon. Apple is not to be underestimated as a bellwether. It's not a FAANG anymore. And I say that in a macro sense. I know I'm going on long here because that's the way of the world. Ecosystem models like Amazon, Apple is embracing that. Companies like Costco actually are ecosystem models. Those are the models that actually are anti-competitive because once you're in there, you can't get out. You buy your stuff from Amazon, right? Now you get your recommendations of what to buy from Amazon. Angie Says is an Amazon type of thing now. Your plumber comes from Amazon. They're in your house now. In fact, didn't they cut a deal with a mortgage firm, Amazon? Possibly they're in the process of working with houses. Forget it. It's ecosystem. They're going to be in everything in your house. And that's the macro business model that's going to work. So keep that in mind. Bearish on Apple today, no doubt. But I think as an investment, it might be time to look at it again. So sorry I went on so long, but that's the idea.
No, good info there. I guess, looking at the day, we have Apple up. Boeing came out with earnings. Boeing is higher. The markets start the day higher. Global markets are higher, but then our focus is going to shift later at about 2 o'clock to the Fed. What are your thoughts, Larry, on any sort of, it's an option expiration day. Yesterday we were taking a look, 26.45 call or straddle yesterday was priced at, I believe, $25. We're right now 26.52, so we're not far from there. There will be a press conference today, so all eyes will be on Powell. Any thoughts, Larry or Vince, on ways to express it or opportunities or anything you think might be interesting from the press conference?
The straddle is pricing in about 16, actually about $17-ish. I think that there's not going to be a lot coming from this. Obviously, it's interpretation, but maybe he walks back a little of his dovishness, but I doubt it. I think the Fed has been locked up by Donald Trump to basically go with the new mantra of a little bit slowing down the cycle. I was listening to someone on the way in this morning, and they were saying, I don't know, that they're still pricing in a June rise. I haven't checked Fed Fund futures, but they're saying there's going to be 2 this year, one in June and then one, I think, in November. So I guess maybe 2 was priced in, but I thought that 0 was priced in. So it'd be interesting to call the floor and get an idea of where Fed funds are, because I think our market is pricing in 0. So if there's an inkling that he's going to be able to move from 0, it could put a damper in the market. But interestingly, I was talking to a very good friend of mine who I trade with all the time, and we were saying the news has been kind of negative, but it just seems like the market continually wants to go higher. During the government shutdown, it didn't have an effect, and when the government reopened, they assumed that was bullish. Earnings in general were mixed, some good, some bad, but the bigger names were bad over the last couple of days, and the market really didn't go down. And then Apple is obviously up today, so that has the market higher. We have more earnings to come, but through this week, which we call the Super Bowl of earnings, they've been probably skewed 60 to 70% better than expected, but they're lowered numbers. Like, it's interesting, Apple's up 5%, but if you really look at their earnings, they're the worst earnings they've had in a holiday period, probably in 20
Larry, I think
plus
it's
years.
their first negative earnings in a long time. I mean, they may have managed it well, but I think it's like their first negative earnings ever.
I just like to go into one of their warehouses where they house these phones and see how many iPhone 10s there are laying around, because it's got to be
No doubt.
epic. epic
No doubt.
numbers.
And they have to feel that too, which is to the point of they're going to a service company rather than a hardware company. You know what I mean? They're no longer, I think they have to pivot off of the phone, and they have to pivot to a new growth area, and that is to monetize their client base. But if I could echo something that you said in different words that I've sensed in a different way, we've in the past talked about how the Fed funds may be discounting X, but the stock market discounts more hope. And there's a market structure bias there that I think cannot be underestimated. And if you're looking at the stock market since last Monday, when there was the leak that, or the I guess the red herring that the Fed's going to be less aggressive on QT, and stocks and gold and anything that was denominated in dollars rallied as the dollar softened. And meanwhile, you're still seeing, to some extent, 1 to 2 hikes down the road. I gotta say, for reasons not parallel to what Larry's saying, but in agreement, if there's an 80% chance of not having a hike, or if there's an 80% chance of a hike, the stock market discounts a 60% chance of a hike. And to the point, if you want to come out digitally and say Powell's going to be even more dovish, then stocks scream higher. Powell's going to be pull back on his wording, which is unlikely based on what you said. Then stocks would drop. Powell says nothing different than what's been said. I don't know what stocks do, because I think they're already overpricing in euphoria again, as usual. So I feel like in 2 out of 3 scenarios, stocks will react negatively to what comes out of the mouths of the FOMC. Who knows, though?
Yeah, I tend to think not much is priced into this meeting. They were never expected here, and really the next hike that's even potentially priced in is.
No,
I think
I respectfully disagree, because quantitative tightening has 2 aspects to it: raising rates and offloading debt off the balance sheet. And it was clearly leaked, clearly stated early this week or late last week that the Fed was seriously considering slowing or stopping the offload of debt. That doesn't mean they can't raise rates.
I agree
but
with what
it
you're
does
saying
mean
there.
they're going to be looking to not offload the debt. And QT is not just monetary policy.
Yeah, that will be the one really interesting point in this press conference. And I think it'll only come in the press conference. I don't think it'll come in the text before.
I agree.
And that'll be for the first question.
The text is going to be the, what do you call it? The nothing burger, possibly.
Right.
And how he responds to questions is it. And I say that respectfully. A lot of people, and I know you understand this, Mike, a lot of people think raising rates is the only thing QT is. It ain't, folks. It means debt is being thrown back into the market. And if they stop throwing debt back into the market, that means they're raising rates, but the debt that the US government holds on to will increase, not decrease. So raising rates while holding on to debt and not rolling it off or selling it back into the market means that the debt service of the United States grows. I am not so sure that Fitch would be happy with that. So I don't care how much we raise rates. If we don't get rid of the debt, you're going to slow an economy down that's indebted. That's the stagflation scenario. So you're right. I think the conference is more important than the statement. Absolutely.
And it looks like, I know you talked about it on the gold fix, but gold grinding back up, was overnight, hit the highest level since May, I believe, of last year. So I know gold will have all eyes on what the Fed says, and probably short term will be driven by the dollar in the, by what the Fed says, things like that.
The only thing worth saying about gold, and Larry and I joke about this because it was so right $100 ago. Remember the old gold hates the teens phrase? Well, we have a chance to test that again. Gold spot is below the teens, but the front month or most active month now is April, and that is in the teens. So what now? I firmly believe that based on history, although I'm not married to it, gold hates the teens. So I'm flat, and I'm not doing anything gold or dollar or precious metals related, or probably anything going into the Fed. But I am looking for gold to be a little bit overbought, which means if you're a dollar trader, an FX trader, that means the dollar is a little oversold. Who the heck knows? But
do you think that the Fed is really going to be a big market mover today?
I
I
don't
mean, no
know.
one knows for sure, but
Well,
I
I don't know, but I'm not taking that risk. You know what I mean? Like that's and that is the definition of black swan. You know, if you say this could happen, you know, when I say you, I mean, and when everyone says X is a black swan, wrong. A black swan is something you haven't thought of. As ridiculous as Rumsfeld sounded years ago when he said, "Know what you know," we understand that. Know what you don't know. Traders understand that, and you have to be aware of the unknown unknowns. Like that just made me want to twist my head off. But what he really was saying in a ridiculous way was there are things you don't even know you don't know about yet. And those are black swans. And that's why I'm, saying I'm 80 Delta. Let's say that I'm on your side of the camp, 80 Delta, that whatever the Fed's going to say is discounted in the market, 80 Delta uh, or 95 Delta. I think that 5 Delta, Pal tripping on the way and getting hit by a bus. I want to be flat going into the meeting because I really don't know. And I have no system signals other than Bitcoin and Apple to trade. And I'm scared to death because I've had a couple good trades in a row that my ego is going to get in the way and make me do something stupid right now. So I'm just kind of like taking a breather. It's self-management.
that makes sense if you're not feeling good about it. For me, I don't expect much. I think that he's been tamed and he's in line. The surprise potentially could come to the downside that he's a little bit more hawkish than expected, but I don't expect I don't expect much
But
out of him.
I count you as a reasonable person compared to the market itself. What I mean is, when you say the statement, "I don't expect much," I'm going to take that as a truism. And then you say the statement that also is, uh, "I don't think he's going to change much." That also is true. But but yet, for I think solid reasons, you're mildly bearish from what I can gather, and that's because the market just prices in, hopium.
Well, I am a little bit cautious, but I noticed the trend over the last few weeks has been higher. And like I said earlier, the market has been going higher, shrugging off really bad earnings. And then when they get good earnings, it's going higher. So it seems like it's a market that at this level wants to go higher. I was saying to Mike before we got on, it's interesting. On Christmas Eve, we traded 23.16. We're now at 26.52, which is 335 points higher. And if we go up another 335 points, and this only took 2.5 trading weeks, we'll be at an
Detroit.
all-time high. So
I believe it's 20% in 20 days, Larry, and there's a perfect symmetry to it.
yeah, so that's what we have here, and it's just too much too fast. And volatility on any down move is getting above 20. It's now at 19 because we've rallied the last couple of days, or today.
It,
Um,
and
but
I think volatility is the key going forward. But you made a comment that new subscribers or relatively new active traders may find seemingly contradictory, but it's not. And that is, we see stocks during a Fed week shrugging off bad earnings. To your point, overreacting if you're objective about it to neutral or positive earnings. And you scratch your head and you say to yourself, well, why is that? Well, you take a step further. It's because the market is really focusing on the Fed, and that's part of a concept that professionals understand, and that is called stock versus flow. And by stock, I don't mean stocks; I mean inventory. Inventory versus flow. It's one thing to say we're going to raise rates to 5% because the market will just take bonds to 5%. That's called stock. We have this much to buy or sell. But it's another thing to say flow. We're not telling you our target, or maybe we are telling you our target, but we're not telling you how we're going to get there. And that's the flow of the Fed. And I think that's what the market is trying to predict, that the flow of the Fed will be to continue to back off on QT or reaffirm it. And that's why the market is rallying or firm in the face of bad earnings. Long story short, the market is reacting to flow, that is liquidity, increased or decreased, more importantly than earnings. The tail wags the dog now, folks, and trade it accordingly.
Yeah, we'll see. Today should be interesting. Mike, who do you have scheduled up for today?
We have the DOE report coming out at 10:30, and shortly after, we're going to have Andy LeBeau talking about crude oil. And have him back on Fed and press conference.
Excellent. Thanks for joining us, Vince, today, and we will see everybody in the chat. And good luck to all the traders, and be safe around the 2 o'clock Fed, and happy trading in Apple. I think there could be good levels here to potentially look to short the name.